प्रेजेंटेड बाय ईबिक्स कैश। हर खुशी के लिए काफी है।
Hello and welcome. You're with us here on Business Today. I'm Abha Bakaya. Here are the headlines tonight. Bears take control of the Lal Street. Sensex sees biggest fall in 7 months. Nifty ends below 17,450. Auto, PSU Bank, Realty take a hit. Reliance Industries plunges on calling off Saudi Aramco deal. Stock erases nearly $9 billion market cap in today's trade. Paytm's poor run continues on the Lal Street. Investors lose 36% in 2 days. Company lost nearly $10 billion in valuation. Bharti Airtel hits new life high as company raises prepaid tariff by 20 to 25%. Other telcos may follow suit. And later on the show, we'll get you an exclusive conversation with our market guru Sunil Singhania on big market crash. It was a sea of red on the Lal Street today. Amid heavy selling, markets witnessed their worst day in 7 months. Today's market sell-off wiped out over 8 lakh crore rupees of investor wealth. Sensex tanked over 1,000 points, slipping to 58,000. On the other hand, Nifty also ending over 340 points lower, ending below the 17,500 mark. Some reasons that led to the fall today include Paytm continuing to disappoint investors, falling over 13% in trade today. Secondly, Reliance alone accounted for nearly 1/4 of the day's losses after the Saudi Aramco deal was cancelled. Oil hitting a 7-week low also hit market sentiment. A worrying jump in COVID cases in countries across the world and persistent selling by foreign investors also spooked the markets. Our global business editor Udayan Mukherjee joining us now on the free fall today. Udayan, what are you making of it? We've been talking about this for a while, wondering when the market would lose steam, but it clearly seems to be reacting rather, perhaps to the Paytm listing and the weak listing that we saw there, perhaps to some other triggers. What do you feel drove the markets lower today, and is this just the beginning?
Hi Abha, but we've been speaking about this prospect for some time now, and I did mention last week as well that the Paytm listing will be quite influential in determining the near-term course of the market, because we've seen this story play out before. A very hyped IPO, a very large one, comes and hits the market, has a very poor listing, and that often turns the mood sour for the time being. It happened many years back with Reliance Power as well. So I was always apprehensive that something like this might happen with the very loftily valued Paytm. We did speak about it, and it's turned out that the market has reacted quite badly. But now it's difficult to say whether this correction is over, because we have corrected quite a bit. You know, it's 1,000 points in the Nifty already from the near-term high of 18,600, which we hit a few weeks back. And I have been telling you that 18,600 could possibly be the peak for the year. And it's increasingly looking like that might have been the top for the index for the time being. But I think it would be unfair to put all the blame at Paytm's doorstep. There are some other factors as well. I think the Reliance factor, the fact that the Aramco deal might have been called off, that led to a fall in the stock and might have soured sentiment a little bit. The repeal of the farm laws over the weekend, sentimentally at least, seems to have affected the public sector stocks, and those corrected quite significantly. So I think it's a combination of factors which have come together. Remember, the market was overvalued or highly valued and ripe for a correction in any case. When that happens, then any factor or a combination of factors can trigger off a sentiment-led correction, and that's pretty much what we've seen today. I don't know where it stops from here on, but I think reclaiming the highs for the year will be quite difficult, and I think in the near term we should brace ourselves for more volatility, because the market is still expensive despite the correction. And the way the India VIX has spiked up 18-20% today leads me to believe that there might be more volatility in the days to come. Sunil Singhania joins us on the show today. Sunil, good to see you after a long time, but it's an interesting juncture to be speaking to you, because after a long time the markets are correcting, and correcting quite sharply. Is it the Paytm factor? Is it the Reliance factor? Is it the repeal of the farm laws? What do you think is worrying the market or leading or triggering this correction?
So, thanks for having me, Udayan. And it's always easy in hindsight to, pinpoint the reasons for what has happened. But I think last couple of months, money making was becoming too easy, frankly. And all these IPOs opening at like 100%, 200% premium and getting subscribed to 500 times, 1,000 times was getting a little bit unreal. And frankly, despite the fact that some of these have created businesses like out of nowhere and we adore them, I think the valuations were a question mark. At least, conservative investors like us hardly understood it. So I would say it's a combination of a lot of things. The market needed some reason for it to correct. And maybe the Paytm reason was a bigger reason, and all others just added to it. So I would say that it's been a sort of a welcome correction. Obviously, no investor likes a correction. But the fact of the matter is, what we are down like 5-6% from the top. So it's hardly a meaningful kind of a correction. And from here on, it's always good that, you cool down a little bit, you get your bearings in place, again, figure out things which might not be the best things to do in as far as investing is concerned, and then move ahead.
And what's an old-fashioned investor like doing in approaching these new digital listings? They've all corrected after the Paytm episode. Are you looking at them closely, or do you think they still have not arrived at valuations which would tempt a traditional investor like you?
So again, first of all, it's not necessary that if you're a traditional investor, you don't like growth. Frankly, we have been very successful, and so have been the other investors in buying growth stocks. But, there is always a value you put to it. So I think the one thing which we always remember is that what you pay today to buy a stock has to be more than repaid by way of future profitability. I think that is one condition which is sort of, non-negotiable. As far as some of these recent IPOs are concerned, clearly, as I said earlier, we adore them. They're entrepreneurs who have created new businesses, have brought in a lot of FDI for India, and have also created, hundreds and thousands of jobs, and, salute to them. At the same time, the fundamental aspect of valuing them has been something which at least we as investors have not understood. So as I said earlier, there has to be some sense of future profitability coming in. So either you are building a business to make profit, or you're building a business to just list or sell out. And, obviously the second seems to be more the thought process here. And that is the reason, at least we have avoided this hype kind of new age businesses. There are some businesses which will do very well, even in the new age businesses. Some businesses we like. There will always be difference of opinion as far as valuations are concerned. But quite a few of them have got listed just based on the perspective that they might go up in stock prices, not necessarily make profits.
Now, you said correctly that it's only a 5-7% correction after such a big run. And the run has been stupendous in the market, given where valuations are. Even allowing for the fact that a new earnings cycle might be beginning, would you expect this correction to deepen? Because even strong bull markets take in at least 10%, sometimes even 20% running corrections. What do you think this one could be like?
So you're right, Udayan, for us to go to 10% is another 3-4%. And I would say that would be our sort of a guess that maybe, 3-4% left as far as the markets are concerned. Actually, if you go in the broader markets, stocks have corrected anywhere between 10 to even 25%. So the correction is not very visible from the headline Nifty. Actually, if you go deep down, stocks have actually corrected 10 to 25%. And that's not a very pleasant thing to see if you have stocks which have corrected so sharply in your portfolio. Our view is that there are a confluence of factors on the positive side. Obviously, as you rightly said, earnings growth looks phenomenal. Next 2 years, FY22 and FY23 put together would see a 50% increase in profit compared to FY21. Valuations are not cheap, but they're not exorbitantly expensive. I think come January, February 2022, we will all start to talk about financial year 24. And on that basis, we are like at 18.5 times. And, it's 15% higher than the long-term trend, but it's not like completely out of whack. And then given the fact that at least our view is that liquidity is going to continue, and you also have a confluence of both private capex as well as the government capex coming in. I think we are getting into a good situation where GDP growth can surprise on the upside for the next 2-3 years. What we also have to not forget is that traditionally, the November to February, March period is a good period as far as rebalancing of FI, allocations are concerned. And at least, my interaction with friends overseas point that India might be gaining in terms of allocations at the expense of maybe China in this round. And therefore, on this correction, our view is that smart, institutional inflow should start to come in. We are also heading into a phenomena or a phase where government is on an overdrive in terms of privatization, in terms of getting the economy back on track. We have the union budget coming in January, and traditionally there also is a rally preceding the budget. So I think both on the fundamental and technical factors, our view would be that max maybe another 3-4% to go, and then we should start to see some semblance of stability coming in.
Sunil, what else is exciting you in terms of a longer-term horizon? We've seen IT companies outperform and continue to surprise on the upside. Is that a trend that you're continuing to capitalize on? Are you investing or looking at allocating more when it comes to that bucket in the market?
So, one is, we are lucky to be investing in India, and we've been eternal India bulls, and it's helped. Being positive on India has helped. And I think next 3-4 years, we again see a good sort of a cycle of growth led by lower interest rates. And obviously, generally, companies doing quite well. I would agree with you on the IT services/digital front. Digital as a segment is awesome. There is no doubt about it. Our own individual habits of using digital for everything we do is there for everyone to see. The only problem has been the valuations. And, if we get, an opportunity, maybe, this meltdown in some of the digital plays would allow us to invest in future IPOs of good digital companies, maybe at a decent valuation. That would be a great opportunity. Maybe some of the listed plays might give us a reaction and allow us to invest. I think digital as a theme cannot be ignored. IT services, again, there has been meaningful correction of almost 15-20% in a lot of companies, maybe a little bit more correction. I think Indian IT services company are globally competitive. There is this huge move globally towards moving into digitization from all corporates. And I think we are already seeing demand, being very robust. Some of the other segments where we are quite positive are homegrown brands. We are seeing consumption coming back all over the country, particularly in tier 2, tier 3 towns and smaller cities. We are seeing a phase where after 2 years, entire country is opening up. We saw how during the festive season demand has shot up. In the next 6 months, I have heard that there are a record number of weddings. When we see our own circle, no one celebrated their anniversaries and birthdays and so on and so forth. They're all going to come back. So I think the next 6-8 months, discretionary consumption should do very well. At the same time, we have to remember that, there are two pockets of discretionary consumption. One is the very obvious names which are trading at 80-90p. I think those are not something which we are looking at. But at the same time, there are, as I said, the second tier brands which are focused more on towns and smaller cities. I think that is where there is huge opportunity.
Do watch the entire interview with our market guru Sunil Singhania on businesstoday.in. After a flop listing for Paytm on Friday, the market cap of the scrip has fallen tremendously. Valued earlier at $19.9 billion, Paytm has eroded $10 billion of market cap in trade. The stock ended 27% below its issue price on day one, and it continued bleeding on day two of trading, closing 12.7% lower. With today's fall, the stock has fallen 36% against its issue price of 2,150 rupees. Following Paytm's heavy sell-off, recently listed shares like Policybazaar, Nykaa and Zomato are also witnessing a huge slump today. Zomato share price dipping near 7%. Policybazaar or PB Fintech shares went southward to the tune of 8%, and Nykaa's share price also went off around 1% or so in the intraday session. Sunil Singhania of Abacus Asset Manager says that He's still quite bullish on the Paytm story, believes that even though the stock is listed at a discount, it can do better in the coming months. Listen in.
Paytm is a great startup which has been built painstakingly over the last few years. Even I use it, at least as far as payments are concerned. As far as investments is concerned, obviously, it's upon the investors who have invested, to answer that question. I think what has happened, maybe, what typically happens, Abha, is that if an IPO opens at a discount to the offer price, there are a lot of flippers or, investors who just invested to flip and make some listing gains. They get a little bit nervous and they just want to close out their position. So it just adds to the softness. And obviously, the fact that the markets have been soft over the last 2-3 days in particular has not helped matters. So it's been a confluence of factors. I think it will take some time, maybe, to stabilize. There have been instances where companies have listed at a discount and have come back if the fundamentals start to keep pace. But let's see how it pans out.
Bharti Airtel hitting an all-time high after the company announced 20 to 25% tariff hikes on prepaid plans. The move comes in compliance with the company's stance that ARPU needs to be at 200 rupees and ultimately 300 rupees. As per the company, the decision was taken for a financially healthy business model. The hikes come into effect on November 26th. The 79 rupee plan, for instance, will cost 99 rupees. The move could signal a wave of increased tariffs as companies look at ways to gain profit ahead of the upcoming 5G wave. We could also possibly see other players like Jio and Vodafone Idea increase prices soon. We spoke to Sunil Bharti Mittal last month, where he said that Indian tariffs are very low even when compared to emerging markets. According to Airtel's top boss, lower tariffs are a large burden for weaker players. Listen in.
We all know the Indian pricing is very, very low. Lower than most of the places in the world, but by far the lowest, I would say, even in the emerging markets. So, we are not seeking the $50 or $70 per month ARPU that the Western world enjoys. But let's see how far this can go. The fact is, it's an acknowledged position, and you're kind of confirming that in your question as you frame it, that the current tariff levels are unsustainable. How far this can go in this scheme of things will have to be seen. But yes, I would agree with you that especially for the weaker players, lower tariffs puts a very large burden on them to grow in the marketplace.
Reliance Industries plunging over 4% in trade after the company said it had mutually decided with Saudi Aramco to re-evaluate a proposed investment in the O2C business. Reliance and Saudi Aramco signed a non-binding letter of intent in 2019 for a potential 20% stake acquisition by Saudi Aramco in the O2C business of Reliance. If the deal had materialized, it would have set a valuation benchmark of $75 billion. But analysts believe that the deal cancellation has no bearing on Reliance's balance sheet. Remember that the Aramco deal was initially expected to assist Reliance's plan to become a zero net debt company, and Reliance has remained net debt free since June last year. Let me also bring in Sanjeev Bhasin, EVP Markets and Corporate Affairs at IIFL. Sanjeev, thanks so much for joining us. So with Reliance's shares nose-diving after the news today on the re-evaluation of the proposed investment by Saudi Aramco, from an investor standpoint, what do you suggest the strategy should now be on an RIL?
So look, the Saudi Aramco deal was took place in August 2019 when Reliance's market cap was below $100 billion. The stock price was $1,400. Crude was $60, and nobody had envisaged what COVID would do and what the Geo platform would unveil. After that, there's been a rethink. Crude is at 80. Reliance has raised almost 2 lakh crores of money through the digital side, and green energy and renewable energy is the new, new oil, which I would say. So I think it's a relook, and it's also, I would say, a bit of a positive. So in the short term, we've seen this fall in Reliance more to do with external factors, but I think it's a buying opportunity. Simply put, because Reliance is now looking to go towards $200 billion, their ascent on digital and green energy is more important than O2C. And for a 20% stake from 1400, the stock is already hit a high of 2700. So I would tell investors that do a SIP, because I think Reliance in the next 3 months is definitely hitting new highs.
Sanjeev Bhasin, thanks so much for joining us and taking us through your view on Reliance. According to CyberX9, critical financial and personal details of millions of Punjab National Bank customers were at risk for over half a year owing to a vulnerability in the bank's servers. Our tech editor Ayush Alavadi brings you this exclusive report.
Billions of bytes of critical data belonging to 180 million customers of Punjab National Bank all stood compromised for nearly 7 months, according to a cybersecurity firm in Chandigarh. The firm says the issue was fixed on November 19th after it flagged off the incident to the Indian cybersecurity watchdog CERT-In at the NCIIPC.
It might have been exposed to some attackers or hackers for last 7 months, and they were being able to get an access of internal PNB system that is related to getting an access of any employee of any senior level management to any powers that PNB employees have, that is regarding to transfer of funds, accessing personal information of more than 18 crore PNB customers, as well as all email IDs of PNB on PNB network that were accessible and that were downloadable.
This is the same firm that reported a vulnerability at CDSL a couple of weeks ago that could have exposed the data of nearly 4 crore investors. And while these are some big claims being made about the Punjab National Bank servers, the bank has categorically denied that any sensitive data was compromised. Well, it's all part of a much bigger global problem. PayPal, American Express, the Reserve Bank of New Zealand, and even Microsoft are all companies that have fallen prey to some form of cyber attack in the year 2021 itself. In the cybersecurity world, they say prevention is better than cure. And that's why banks will need more robust cybersecurity audits, better technology, and increased awareness now more than ever before. Stay tuned to Business Today for more.
That's all from us on the show today. Thanks so much for watching.